Hi, everyone. This is to help you do your homework for Chapter 3. What I'm going to do is go through Problem 3B2, which you have from email last night, and it's also included in the module content. And what I'm asking you to do is go to your textbook, and you want to be tracing from page 114. So go to page 114, where close to the halfway down you'll find problem 3B2. Of course, your assignment is 3A2, which is a spitting image of this one here. So I keep repeating myself about your homework should look like the B problems that I post for you. So for you to get full credit for those problems, those homework textbook assignments, you want your work to look pretty darn much like what we're doing here. Okay? So on the top of this, I noted the steps in performing this problem and the reality of accounting in terms of the recording function all the way to the closing process, which is in the next module. First starts off by each period. We have to analyze each transaction and enter them in a journal, a general journal. We don't record directly into T accounts. Hopefully, Chapter 2, you learned T account recording. The ledger accounts in a real business have a basic T structure, but I'll show you in the ledger here. You can see this is a general ledger of Barbie's Art Studio, so that we don't record directly into the ledger. We first record in what they call a book of original entry, a journal. So that presents itself as like a day-to-day diary of what has taken place financially in the business. So that, and of course, those are transactions that have impact on the elements and subcomponents of the accounting equation, but do not record first in the ledger. You record first in the journal, then you post in the ledger. I'll be back to that momentarily. So you can see the basic T form here, and then the account at the is either going to have a debit or a credit balance depending on the kind of account it is, and is either going to be increased or decreased, as you can see here. We'll come back to it. Okay, every account has an account number. Usually assets are prefixed with the number 1. And when we get down to liabilities, you see they start with number 2, so you can kind of identify an account as being an asset, a liability, or an owner's equity account. Withdrawals always follows the capital account, and then the temporary capital accounts. The fees earned is a revenue account. We don't record revenues directly in capital. We keep them in their own separate accounts so that when we prepare an income statement, we'll have them all separated. Here they're using the number 5 as the leading number of the expenses. And then the last thing you are supposed to do in this, as you did in Chapter 2 as well, is to prepare a trial balance, which is nothing more than listing out the total debits and the total credits, account by account in the same order in which they are presented in the ledger. So you'll see the listing of the assets first. That's usually referred to as general ledger order. The assets first, then the liabilities and capital account with the negative capital account and the temporary capital accounts. Negative capital would be the withdrawals, which is a temporary account, gets closed, revenues and the expenses as well. This is an informal presentation of the balances in each of the accounts at the end of a given period, and it becomes a springboard to move forward to the period end processes. So if we were to prepare financial statements, typically this would be the first trial balance that we would analyze and see if there are any accounts in here that need to be adjusted, so that before we prepare any financial statements, we've got to make certain adjustments in these accounts. That comes in module 3. That's coming up. So we adjust the accounts, then we prepare the financial statements, and then we close the temporary accounts to reset them to 0 so that they can start accumulating their individual impacts on the owner's equity account. We'll have much to say about that later. But let's come back to the starting point. Again, we want to analyze and record each transaction first in the journal, book of original entry. Then we're going to post each transaction to the ledger that you saw below, and I always suggest recording the transactions first and then posting each to the ledger on a line-by-line basis. And the third task is to prepare the trial balance from the ending ledger balances, and I just refer to that down there. This is to prove debit and credit equality and gets the accounts in place for the end of period tasks of adjusting preparation of statements and the closing of the books. Let's go through some of these transactions here. We can go through all of them. Now, look at what you got to do is whether you do it manually or whether you do it in a computer system, your journal should be presentable. And what I mean is it has to have a nice form, nice layout so we can read it. I mean, I can read this journal and see what happened on the first, again, the first, the third, and I know just by looking that the first entry, which reads, again, you take your book, it says Bobby Riley. I think she's the same person in problem 3A2, but anyway, she puts $8,000 into the business. Now, you know that's an increase to cash, and it increases her capital account. Now you've got to translate those increases into debits and credits. So what you're doing is you're setting up the numbers that are going to go to the ledger. As such, we are to debit cash for $8,000, and when it gets to the ledger, it'll cause an increase in its account. We credit the capital account to increase it by 8,000. So what we're basically doing is we're setting up, for example, it's kind of an old-fashioned system here, but what we're doing is if you're the journal clerk, what you're doing is you're telling the journal clerk, telling the posting clerk, by you making this journal entry, you're in essence telling, quote, the posting clerk to get an $8,000 debit into the account itself, which will cause an increase to that account. And you're telling the posting clerk to do the same in terms of the equity account, enter a credit. The rules apply, debit, credit, equality for every transaction. And if you were to use T accounts and spread this thing out across an equation, either or, your equation would balance. So that when you do your journal, that third line is a very simple statement about what took place. Then you read the next transaction that talks about paying 10 months rent in advance for $2,800. Now, when you make a long-term prepayment such as that, you create an asset account called prepaid rent because it has future value, and that's why it's an asset. Uh, when we would adjust at the end of every month going forward, we would take 1/10 of that, or $280, and expense it off. But for now, you're paying the rent in advance. You're creating an asset. Any kind of an account that is labeled prepaid is an asset because you're going to pay now and use later, and that really defines where or denotes where the transaction is going to get recorded. What I mean by that is if you're prepaying for something that's going to be of future value, that comes back to the definition of what is an asset. It's something that we own or have a right to value going forward, so we record it as such in an asset account. You can see it's already been posted here in this completed problem. So these are the account numbers to indicate that the amounts in fact have been posted. You have to kind of do this hand by hand. Mind you, if you were in an electronic system, you'd still have to either type in these entries or do them by hand as they're done here. One of the best things about a computerized system is all you'd have to do is click save for each entry, or click post for each entry, and it automatically updates the ledger. But what you're doing is you're doing it by hand, so you're really kind of building building the account balances as you go by recording the transactions manually and then posting them manually. So it's not all machine done for you. I think at this stage of the game, we kind of learn better to see the action in the accounts when we get to the ledger, as to how they go up, how they go down, and you got to do the arithmetic to create the new balances. Let's move along. So when you read your book, you'll see that they made a purchase of equipment. You know that's an asset. You've got more equipment in, so you brought something in of value. That's an asset. You're asking yourself, how do you increase an asset? And you do so with a debit of $1,200. And you have to balance it with a $1,200 credit. And your analysis comes out by your concluding or your conclusion that you've incurred a liability. Accounts payable, which is going up. You've got more debt now than you did before. So you're going to be telling the posting clerk, so to speak, to add $1,200 to the liability account, to add $1,200 to the equipment account. Now you got your first action here. I'm looking at my clock. Okay, you get your first action. You read in the textbook on the 5th, it says we collected $900 cash. What do we do here? We're an art school of sorts, okay? So we're training teachers how to teach drawing, I guess. But we received the dough right away. So when you analyze, you just ask yourself, what's happening here? I'm getting cash. Cash is coming in. How does cash go up? It goes up with a debit because it's an asset. How does the fees account go up? With a credit. So again, we're analyzing and recording, making sure we have equal debits and credits, and that we're debiting and crediting the proper accounts. We're classifying properly. We're purchasing art supplies on the 8th, as you read, and that's a cash purchase. That's simply a shift from one asset to another. Nothing on the other side of the equation is affected. You're simply putting into another account, another asset account. These art supplies will be used later, and when we use them up, then we have to expense them, just like the prepaid rent. After each month, I think it was like 10% or 10 months of it, 1 month out of the 10 would expire. When you use up the art supplies, you determine your usage and then expense the amount that you use. Now we made another revenue transaction here for $2,500, and this we're selling now, but we're collecting later. So that what we're doing is we've got a claim to somebody else's asset, so that makes that claim valuable to us, and that's why accounts receivable is an asset. And we're adding to the amount owed to us. It's an asset. How do you add to an asset? You enter a debit. How do you add to the art fees earned account? With a credit. If you read into the 10th, you paid your salaries for your assistants. They've already done their work, so when you pay them, you're not buying something of future value. You're buying something or paying for something that you've already used up, so that you immediately record the expense. How do you add to an expense? You debit it. How do you reduce cash? You credit it. Riley took money out of the business for personal use. You're going to add to the withdrawals account. How do you add to the withdrawals? With a debit. How do you reduce cash? Being an asset, you credit it. Another expense for your electricity. Okay, so you can see you got a debit electric expense and credit cash. Again, your electricity's already been used. So, the meter reader comes out, takes a read, and sends it back to the company who bills you, and you pay it. You've used your electric service so many kilowatt hours, and you are charged and immediately are paying for that. If you were going to pay later and file it, then you'd create an account payable for that. And then finally, you got your telephone bill for the usage of $140. So the $140 has to get debited into the expense account, and the $140 has to come out of the cash account. So we're adding to the expense and subtracting from the asset. Now, this is going to go on and on here, but again, what I would do, I would suggest that when you post, you take each item. There is an 8. I'm not going to do it because it'll take all day, but you take each item line by line. So you're going to take that $8,000. You're going to give it to the posting clerk. You're going to give the journal to the posting clerk. She's going to write in November 1st. You don't they put the word explanation up there, which is moot. But where did so you just leave this stuff blank here, and I don't blame you or wouldn't discount your effort here by putting stuff in this, but typically it's left blank like you see it here. But that $8,000 we said has to be debited to the cash account. Where did it come from? General Journal page 1 would have to type or write that in. And what date did it occur? On November 1st. And where did it come from? General Journal page 1. What did that $8,000 do to the cash account? It added to it, so therefore it establishes a balance. Now that's account number 111. Old-fashioned way to do this thing would be to stick the 111, which is already done, in the posting reference box. That's what PR stands for. So when I see that 111 in there, that tells me that's all posted. If that 311 had not be, if you didn't see that 311, let me just cut it out of there, okay? So if you saw that blank like that, you would know that that $8,000 is not posted to the ledger, so that by coming back in and I just paste that right back in there. Okay, so now you'd know that that would be posted, but let me just go down to the Riley Capital account just to show you that that $8,000 in fact was credited into her account. And there it is right there. So you're taking the same information from the journal, date November 1st, 2000 and whatever. Where did it come from? Posting reference, PR, came from General Journal, page 1. And there's the credit. So we debited cash and credited capital. It's like double work, guys, from going right into the T accounts. But this is the way it's done in practice. And then today, of course, once you save the entry, this whole posting process becomes automatic for you. But now you're seeing the effect that the entry has on the specific account. I just added. How do you add to capital, right? You add by crediting it, and therefore you have a credit balance. What I'm going to do is take that second transaction, then I think we'll wrap it up because it'll get too long. All right, but you would take each of these entries line by line. Take the debit to prepaid rent, $2,800. That's an asset. We're going to add to it. We're going to reduce cash by 28. Okay, I won't come back to the journal, but I just want to show you the 28 gets debited into prepaid rent and credited out of cash. Got that? So let's spin down. We want to see the debit to prepaid rent. There's the 28, which has the effect of adding to the asset, creating a $2,800 balance. Where did it come from? General Journal upstairs is numbered page 1. You put the date in. Okay? Now the credit side of that credited the cash account. Now here's where you can see where you keep a running balance so that on November 1st, when you paid for that rent, you indicate where it came from, and it's a credit. And you know that if you're in an asset account, right, debits are additions, credits are reductions, so that if you took the 8,000 and subtracted the 2,800, you'd be at $5,200 as a balance. So that gets you going with the process of posting. As you can see that I don't want you to take again, I want you to take it line by line, just like I did. But just to show you, the cash account is the most complicated. On the 5th, you had another entry adding to cash. So you see the 52 went to 610. And then the rest of the entries in the cash account was one reduction after another. 6,100 minus 450 equals 5,650 minus 1,300 equals, see that? Minus 100 equals minus 110 equals minus 140 equals the ending balance in the cash account. Accounts receivable has that single entry in there when we sold on credit, if you can recall. So most of all these others just have one entry, so those would be either a debit or a credit balance depending on what they are. So at this point, all you have are assets. Now you're going into liability territory, and there was a credit entry in there which established a $1,200 credit balance. And Bobby Riley has her individual entry in there from her original investment. The withdrawals has a single entry in there. There were 2 fees earned. A credit on top of another credit equals a greater credit, 900 plus 2,500. So you've got 3,400 accumulated right now. So remember, if you prepare an income statement, you'd report the revenue of $3,400. That's why we keep these temporary accounts outside of the main capital account, so that when it comes time to prepare the financial statements, you've got everything classified. So your revenues are here, and you pull your expenses. You'll have them right in the trial balance from here, so that you can easily list out the expenses, the revenues, and the expenses from your trial balance to the actual statements. You saw that the cash account had a $4,000 balance, and it's a debit balance. Make sure you carry the balances from the ledger to the trial balance, debit for debit, credit for credit, and you shouldn't go wrong. Uh, so there's the 25 and the 28 and the 450. So those are all your assets. There's your liability. There's your equity account. There's the negative equity account of $100, and these are the revenues here, which are credit balance items, and the three expense accounts, and they do prove to $12,600. Okay, so that going forward now, you've got problem 3 A2 and 3 A3. I don't have the solution yet for 3B2. There's some sort of a malfunction in the owner's manual. I can't seem to dig that solution up. But remember the steps of the cycle, guys. Number 1, analyze and journalize on a day-to-day basis. As each transaction occurs, the bookkeeping or the accounting clerk analyzes the paperwork, asks herself or himself what accounts are affected by these transactions. Are they assets? Are they liabilities? Are they equity or expenses or revenues? Then knowing the rules of debit and credit. You got an asset going up, so what do? You debit it. You got another asset going down, what do? You got to credit it. You got an asset going up and a liability going up. What do? Debit the asset to increase it, credit the liability. And again, this is original entry. This is the journal. This is a diary. This is a log, a chronological listing of transactions of an enterprise is recorded where? In a book called a journal. After we journalize, right? It's like keeping an account of what happened day to day to day and what accounts are affected within the financial structure of the company. And then again, if you were in a computer system, all you would have had to do is click post or click enter after doing the journal, and all of this stuff would find its way in here, including the account balances. That's how easy computerized accounting is. But you guys are building it. It's like building a stick-built house as opposed to having some robot build it. You know what I'm saying? Okay, so there you are, guys. If you have any further questions, just please ask. And as I said in my announcement today, I can't stress enough that you use the resources. I hope to see that you use this 28 minutes, almost a half an hour of my time. Uh, you can't spend enough time. I told you like 8 to 10 hours a week. And if you need more, rewind, stop it, pause, back it up, replay it. I did a lot of talking here. What else is new? See you later.